Hey CMA Foundation buddies, today we will be starting a series wherein we will be solving all the MCQs which are behind your book, right? The idea is to give you insights about the questions that are there in your book, and if there are any errors we will try to rectify. Please remember, this is not an exhaustive understanding of the chapter. This is only answering of question and answers which can be relevant from your exam perspective, right? Let's start with the video right away. Let's start with the first question. We will today be discussing chapter 3, that is all about money and banking, right? So we'll be reading the questions, we'll be solving the answers, and I made certain notes which will clearly explain you why the specific answer has been selected, right? If there is any difference between the answer that there is in the book and the answer which is correct, I would try to give an explanation for that also, although the call is yours, which one you want to select, right? My idea is to give you the correct understanding of the terminologies or the definitions that are given, right? Let's start with the first question. First question says, which of the following is near money, right? Let's understand what is a near money. Near money is a term used to describe non-cash assets, right? Something which doesn't deal with cash as such, that are very liquid. Liquid means that can be easily converted into cash and that are easily convertible into cash. So that's what is very liquid all about. Examples can be savings account, certificate of deposits, foreign currencies, money market accounts, marketable securities, and T-bills, or what we call as treasury bills, right? So what should be the correct answer? Bill of exchange, savings bond, gilt-edged securities, then it should be gilt-edged securities. So the correct answer is all of the three, right? Okay, let's move on to the next question. What is optional money? Let's look at the definition of optional money. Optional money is, it refers to non-legal tender, right? It is not a legal tender, right? Money which do not enjoy any statutory backing, or what you call as a regulatory backing, but it is generally accepted by the people in final payments and in settlements of cash transaction, right? For example, bills of exchanges, checks, etc., right? They are not legal tender, as in you cannot give it in a shop and you can buy certain things, right? You need to put it in the bank, you got to encash, and with the help of cash only you can get the transaction done. So legal tender, currency is basically a legal tender. Anything which acts in lieu of a currency, that is called as a non-legal tender, right? So what would be the correct answer? Optional money is legal tender money, non-legal tender money, limited legal tender money, or full-bodied money. It will be a non-legal tender money, right? Let's come on to the next question. Which of the following function does money serve when used to measure the prices of different goods and services? Okay, there's a small discrepancy in this. As per your book, the answer they have given is basically option B, that is medium of exchange, although I feel it should be standard of value. Now again, it's up to you to decide which option you want to select, although I would substantiate my answer with the help of this note, because standard of value, or what you also called as a measure of value, refers to that function of money which helps in determining the value of goods and services in the economy, right? Or the question itself says when used to measure the prices of different goods and services, right? So I guess standard of value should be the right answer, although as per your book the correct answer that's given is medium of exchange. So that's for you to decide what answer you want to select, but the correct answer here should be standard of value, right? Let's move on to the next question. Which of these affects the demand for money, right? So which of the following, that is real income, price level, rate of interest, both A and C. Now please understand both the factors, that is real income and rate of interest affects the demand for money. So technically the answer should be option D, right? Price level doesn't have any impact on the demand for money, right? So correct option should be option number D. Let's move on to the next one. Which of these would lead to fall in demand for money, right? So which would lead to fall in demand for money? Inflation, increase in real income, increase in real rate of interest, or increase in wealth, right? Please understand, the rise in interest rate leads to fall in demand for money due to increased cost of borrowing and reducing purchase power of the consumers, right? Let's take an example of housing loan. Whenever you take a housing loan, say for example the housing loan that is prevalent is 8%, right? Now in order to control inflation, what government usually does is it increases the interest rates. When you increase the interest rate, your purchasing power automatically comes down, yes or no, right? So if this 8% becomes 10%, what will happen is people will stop spending more money, or that will lead to fall in the demand for money, right? So the demand for money will automatically come down. Hence my option should be option number C. So increase in the real rate of interest is the correct answer, right? Okay, Then we talk about question number 6. Supply of money refers to, let's look at the notes directly. Money supply refers to total stock of money of all types, currency as well as demand deposits. What do you mean by demand deposits? Any deposit which is parked in the bank in a savings account or a current account. So whenever you want that money, you go to the bank, you ask, and that money will be given back to you, right? So that's what is a demand deposit, which is held by the people of the country in a given point of time. So held by the people. So supply of money refers to total money held by the public or by RBI, commercial banks and RBI, total money in government account. No, supply of money refers to the total money held by the public, right? Okay, which is the apex bank for agriculture credit in India? RBI, SIDBI, NABARD or IDBI. NABARD basically stands for National Bank for Agriculture and Rural Credit. It is the apex institution at national level for agriculture credit. So whenever we talk about agriculture credit, we are talking about NABARD, right? Okay, then we go to the next question. RBI check inflation by. Check inflation means they keep a track of inflation, or they can control the inflation rather. By how? Increasing bank rate, increasing CRR, both or none, right? Okay, please look at the note, you would be able to understand. RBI resort to increase in cash reserve ratio to check the inflation, right? Okay, what do you mean by CRR? CRR simply means the percentage of bank's total deposit that it needs to maintain as liquid cash with RBI, right? So basically this amount has to be parked with RBI. Whose deposit is it? It is basically bank's total. So a percentage of a bank's total deposit, it's to be kept as in the form of liquid cash, and it should be maintained with RBI. Okay, the other term here is bank rate. But what is bank rate? The rate of interest which is charged by a central bank while lending loans to the commercial bank. So basically when RBI is lending loan to say SBI, the rate that the RBI will be charging, that will be known as a bank rate, right? So our correct answer here should be both. So it's basically RBI can check inflation by increasing the bank rate. So when the rate automatically increases, the inflation is controlled. Similarly, when you have to keep more amount of money as reserve, automatically the liquidity flow is reduced, which eventually increases the CRR, right? So you need to adopt both the measures by RBI to make sure that the inflation is kept under control, right? Okay, let's come on to the next question. If the country is passing through a recession, okay, the RBI would, during recession, RBI promotes lending, okay, because it's a recession, RBI would give more money in the public, which in turn stimulates economic activity and consumption, right? So what are the various options they can adopt? They can buy bonds, reduce CRR, ease out bank rate. CRR and bank rate we have already discussed. So when you know it's a recession, that means you need to give more money to the public. How would you do that? By reducing CRR. If the reserve is reduced, automatically you will have more money to give to public, right? Similarly, if you reduce the bank rate, in that case RBI can lend other banks at a lower rate of interest. That means their liquidity automatically increases. Or even RBI can buy bonds. When they buy bond, that means they are giving money, which in turn will increase the liquidity in the public. Hence, you can adopt for any or all of any of the above three for passing through recession, right? Okay, manipulation of CRR enables to the RBI. Manipulation means changing of something, right? Okay, let's look at the note first. If the CRR is high, then bank will have to maintain more amount of cash with RBI and vice versa. Yes or no? If CRR is high, bank will maintain more money with RBI. If no, then they can maintain less money with RBI, right? Therefore, manipulation in CRR enables the RBI to affect the lending capacity of the commercial banks. So basically, influence the lending ability of the commercial banks is the correct answer as far as question 10th is concerned, right? Okay, then the question says Exim Bank is authorized to raise loan from. So where can Exim Bank raise their loan or get their loan from? RBI, GOI, international market or trading activities. Exim Bank is authorized to loan from Government of India as per CMA study material and 2016 MTP. Although when I ran through various documents, I did realize that Exim Bank can even raise money from RBI and international market. Although your book is continuously talking about Exim Bank raising money only from Government of India, I would go with the option B, right? Okay. Then it says RBI was nationalized in. RBI was basically nationalized in nationalized from 1/1/1949 on the basis of RBI Act 1948. The correct answer is option number 2, that is January 1949, although in your book the correct answer is given as April 1936. So please make a change. The correct answer should be January 1949, right? Okay, let's come to the next one. FERA has been replaced by, now what is FERA? FERA basically was Foreign Exchange Regulation Act. Now this Foreign Exchange Regulation Act from 99 has been changed to Foreign Exchange Management Act. So the correct answer should be FEMA. Okay, then we come to the next one. Next one talks about next question rather is repo transaction means. Okay, let's understand what is repo transaction. Okay, repo word stands for repurchase. Fine. So the definition of repo transaction is a repo purchase or a repurchase agreement is a form of short-term borrowing. Please remember the key word here is borrowing. Fine. Okay, it's basically a short-term borrowing for dealers in government securities. Fine. For repo, a dealer sells government securities to an investor. Fine. Usually overnight and buys them back the following day at a slightly higher price. Fine. So that's the definition of repo transactions. Okay. Now look at the options. The first option says sale of securities by the holder to the investor with the agreement to purchase them at a predetermined rate and date. Please remember, whenever you talk about repo transaction, it is always at a predetermined rate and date. That means the rate has already been decided. Fine. Hence the correct answer in this case should be 1. Okay. The second option says sale of securities by the holder to the investor with the agreement to resell them at predetermined rate and date. No, they don't have to resell, they purchase it. Fine. Okay, then the third one says sale and purchase of securities by the holder to the investor with an agreement to purchase them at prevailing rate and date. No, it's not at prevailing rate and date. And finally, sale of securities by the holder to investor with agreement to purchase them at market driven rate. No, it is always predetermined rate and date. Hence my correct option should be option number A or option number 1. Right. Then we come to reverse repo transaction. Okay, let's understand what is reverse repo. Reverse repo is absolutely opposite of repo. Okay, reverse repo is defined as an instrument of lending funds by purchasing securities with an agreement to resell these securities. Okay, please make sure it's resell the securities. That means the investor has bought the securities when there is a repo transaction. So basically, when it is a reverse repo, it becomes a commitment by the same investor to sell it back to the holder. So that's what is a reverse repo is. Fine. Okay, again the rate would remain the same because it is predetermined rate and date, right? Okay, so reverse repo transaction means sale of securities by the holder to the investor with agreement to purchase them at predetermined rate and date. That is repo. This is something we have already done in the last question. The second option is sale or purchase of securities by the holder to the investor with the commitment to sell or purchase them at a predetermined rate and date. So basically, when the word commitment is used, in that case, it becomes a reverse repo transaction. So this is the correct answer. Also remember, when we talk about reverse repo, it is an instrument of lending, right? Whereas when we spoke about repo transaction, it was a transaction with respect to borrowing. So that's the key difference between repo and reverse repo, right? Okay, let's come to the next question. This question says, given the reserve ratio of 20% in initial deposit of rupees 1000 in a banking system would create secondary deposit of rupees dash. Fine. Okay, in this question we need to understand a concept which is called as a multiplier, right? Or what is also called as a money multiplier. What is the formula for money multiplier? Money multiplier simply says 1 divided by reserve ratio. Okay, now you know that 1 divided by your reserve ratio is how much? It is basically 20%. So when you convert, this becomes 5, right? Now how does this money multiplier help? It helps you to calculate the total deposit, right? Now the total deposit becomes what? Total deposit is basically your initial deposit into, let's term this money multiplier as K. So basically total deposit is equal to initial deposit into the money multiplier, that is K. So this becomes what? This becomes 1000 into 5, or rather this becomes 5000, right? Are you able to understand this? Okay, I'll just repeat that once again. For calculating the secondary deposit, you need to know a term which is called as money multiplier. What is the formula for money multiplier? Money multiplier simply is 1 divided by the reserve ratio, right? You know the reserve ratio is 20%, so when you divide 1 divided by 20%, it becomes 5. Fine. Now this money multiplier can be used to calculate the total deposit. Now total deposit is K times of the initial deposit. Now in the question, the initial deposit is already given as 1000 rupees. So when you multiply this K with initial deposit, that becomes 1000 into 5, which is 5000, right? What is question asking you? The question is telling you, or asking you rather, in banking system would create secondary deposit. So you need to calculate basically the secondary deposit. How do you calculate secondary deposit? Secondary deposit is simply the total deposit minus the initial deposit. Yes or no? Very logical, right? Secondary deposit will be what? Whatever total deposit is there, if you just subtract the initial deposit from it, you will get a secondary deposit. What is the total deposit? 5000, which I have already calculated here, minus initial deposit already given in the question as 1000. Hence, secondary deposit becomes rupees 4000, and hence that's my correct answer, right? I'll repeat it once again. Basically, to calculate any kind of deposit or total deposit, you need something called as money multiplier. This is termed as K. The formula for money multiplier is 1 divided by reserve ratio, right? Then you calculate total deposit. The formula for total deposit is initial deposit into K, or K times the initial deposit. Then if you have to calculate the secondary deposit, whatever total deposited you calculated here, if you just simply subtract initial deposit from it, you will get the secondary deposit. Hence 4000 is the right answer, right? Okay, then we come to the next question. Next question says money market deals with what? Money market basically deals with short-term credit, right? Here you look at the notes. Money market deals in short-term loans, generally for a period of year or less. So any deposit which is calculated for, or rather which is a loan which is for a period of 1 year or less, that is called as a or money market rather deals with it. Okay, then we come to money market includes. Okay, the short-term loans that we spoke about, what all it includes? Basically, it includes bank accounts, including term certificates of deposit, interbank loans, money market mutual funds, commercial paper, treasury bills, securities lending, and repurchase agreement. So if you look at the option, government securities, treasury bills, bills of exchange, these again are something which we have already discussed here. Hence our correct option should be option number D, right? Okay, now we come to the next question. In Indian money market, who are the main borrowers of short-term funds? Okay, let's look at the notes. In the Indian money market, the main borrowers of short-term funds are central government, state government, local bodies such as municipalities, village panchayat, etc., traders, industrialists, farmers, exporters and importers, and general public. So if you look at the options, central government, state government, local bodies, all of the above, hence D should be my correct answer, right? Let's move on to the next question. Money market is controlled by. Now basically money market is always controlled by RBI. Hence my correct option should be option number B. Okay, now come to the next question. Okay, question says in April 1999 the government of India introduced the bill for a period of 91 days, 182 days, 364 days and none. See, if you look at the chapter also and you look at the other material, reference material also, this should not be 1999 as given in your book. It should be 1992, because that's the period when government of India actually introduced the bill, which was for the period of 364 days. Although it says 1999, I'm not very sure. I tried to search, I didn't find anywhere reference to 1999. Although your book yourself talks about that in 1992, T-bills, here the bills that is being referred to, that is basically T-bills. T-bills were introduced with varying maturities up to 364 days, were introduced in April 1992. This is absolutely repetition of what's there given in your book. Hence the correct answer should be 364 days, but I guess this should not be 1999, that should be 1992, right? Okay. And then we come to question number 22. Question number 22 is, in call money market, funds are borrowed, let's put a comma here, funds are borrowed for rent without any security. That means there is no collateral given for the period of 1 day, 14 days, A and B and none. Okay. Now you need to understand, call money is basically borrowing or lending of funds for 1 day. So if it is an overnight borrowing, that is within 1 day the transaction is done, that is basically called as a call money, right? But when money is borrowed or lent for a period between 2 days and 14 days, it is known as a notice money. Now the question automatically asks you that in call money market, funds are borrowed without any security for the period of how many days? Answer technically should be 1, but in book it is given as A and B, that is 1 day and 14 days. My contention is 1 day is basically for call money, and when it is from 2 to 14 days it is called as a notice money. But your book says A and B, so please check for yourself what is correct, but I personally feel the correct answer should be 1 day, right? Okay, now the next question is, buyer of the goods is called as. Before we draw a drawee, payee or none, before answering this question, let's read these notes. These notes are directly from your book. Okay, when you talk about the commercial bill market, bill of exchange is drawn by the seller. Okay, so in commercial bill market, bill of exchange that is being drawn, that is drawn by the seller, who's called as a drawer, on the buyer, who's called as a drawee and acceptor for the value of goods sold, right? Once the bill is accepted by the buyer of the goods is what? Who? He is a drawee. It becomes a legal document acknowledging indebtedness. That means they have taken the loan, right? Hence the buyer of the good is actually called as a drawee. That is option number B. Let's come to the next question. Certificate of deposits are issued by the banks to. Certificates of deposits is issued to whom? Individuals, corporations, companies and funds, among others. So individuals, companies, PSUs, again they are companies, and PSUs do raise certificate of deposits. Hence my correct answer should be option number D, or all the above, right? Let's come to the next question, which are unsecured promissory notes. Let's understand what is the meaning of unsecured promissory note. Secured promissory note is an obligation for payment without any property securing the payment. Unsecured simply means that you don't have anything to mortgage, or you don't have any collateral. Now what do you mean by mortgage or a collateral? For example, if you take basically a housing loan, fine. Now whenever you take this loan, you need to give some kind of security to the bank, right? He cannot simply give you the money. The bank can't simply give you the money, and if you tomorrow run away with money, then bank will have no security. So whenever you take a bank loan, in that case your house becomes the security of that loan, fine. So that is called a security, right? Similarly, if you take a vehicle loan, right? So whenever you take a vehicle loan, your vehicle is basically kept as a security with the bank. Okay, so similarly, so that's what it is asking. What is exactly an unsecured? So whenever I say unsecured simply means that there is no security that's been given, or nothing is being mortgaged, or nothing is being hypothecated, right? So basically unsecured promissory note is an obligation for payment without any property securing the payment. That means the amount is being given, but there is no security taken from the party on the other end. Okay, now please understand, commercial papers are basically unsecured promissory notes. Hence my correct answer should be commercial paper issued by corporate entities. Now who issues commercial papers? It's been issued by corporate entities to raise resources for their short-term needs instead of borrowing from banks. Okay, now what is the advantage of unsecured promissory notice, or rather commercial paper, is basically commercial papers carries a higher rate of interest. Why it carries a higher rate of interest is because of the fact that because there is no security given, so the risk taken is higher. Since the risk taken is higher, automatically it carries a higher rate of interest. But certificate of deposits or T-bills or certificate of deposits basically are issued by banks or the government, which is considered to be a very safe instrument. Hence it is not unsecured. So the correct answer should be commercial paper, right? Let's come to the last question. The last question says, commercial banks provide collateral loans against. Okay, commercial banks provide collateral loans against collateral securities or by keeping some assets on mortgage. Right, something which I explained right now. If you have some security, that security is also called as collateral, right? So hence the amount of credit creation is also limited by the total amount of mortgageable securities in the country. So basically commercial banks provide collateral loans against bonds, government securities, both A and B, and none. The correct answer should be C. Commercial banks can provide collateral loans against both bonds as well as government securities, right? Okay, so with this we finish all the MCQs of chapter 3. Now if you like such kind of content, please comment so that I can discuss more questions from the economics chapter, and I would try to discuss both fill in the blanks as well as the match the followings as well, so that you have more clarity. My repetition I again want to repeat that please don't take this as exhaustive understanding. This is only the discussion of book back questions. Although this I would be able to explain you certain topics, but ideally you should be going through all the chapters, right? Okay, thanks for joining. Please do like the video if you like this content, and please do subscribe to the channel, right? Thank you for joining and happy learning.